Hi there, and thank you for tuning in to The Money Program, a show about dollars and cents. I'm your host, Kate Sullivan, and each month we cover a new financial topic in hopes that you can pick up some tips and tricks to help get your financial situation straight. Today we're going to be covering dealing with debt. Not everybody likes to talk about it, but everybody has to get a handle on it. The latest statistics from the Federal Reserve say that there's consumer debt is over $3 trillion, with 26% of consumers having some sort of credit card or revolving credit card debt. Right now, the average household credit card debt is just over $7,000, and that's a pretty big number. 74% of all debt is more of a loan product from autos, school, home, and it can be very overwhelming. So today we have Dan Picard. Dan is the Consumer Lending Manager at City of Boston Credit Union. He has over 20 years experience in the banking industry, and he is also a certified credit union financial counselor, so really qualified to help us with some tips and help out getting a good understanding about debt. So welcome to the show today.
Thank you, Kate.
So, you know, there's debt. Everybody has it. But what kinds of debt are there, you know?
Primarily, there's two major areas of debt. The first would be secured debt, focusing on items, mortgages, automobiles, boats, trailers, anything that has collateral associated with it. The second type of debt would be unsecured debt, your personal loans or traditional credit cards, department store credit cards, American Express, Discover, Visa, MasterCard.
Now, when you say the secured ones, which have, you know, some sort of backing to them, I've heard about you can take loans against savings that you already have. Like, how would that work?
You could do a collateral savings account loan. So you would pledge $5,000, $1,000, whatever you have in your savings account, and take a loan against that same amount, and then basically repay yourself back. The downside to that is you're paying a premium on the interest. They're going to pay you, say, 0.25%, 0.5% on the deposit side, but on the loan side, they're going to charge you 3.5%. So you're still paying on your own money.
Still paying on it. Now, when you talk about the unsecured, and those are the credit cards and the personal loans, they both seem to provide you with money that you need at that time. What's the real difference between that types of unsecured debt?
A personal loan has a set term associated with it. It's traditional closed-end lending. You can obtain a personal loan for a 12-month period, 24-month period, 10-year period. A credit card is an open-ended product. So the bank or credit union assigns you a limit, and you may use that limit. You could pay it back, you can use it again. That limit is there, the payment associated with it is there. If you don't pay the balance off, based upon the credit card projections, the minimum payment may take you 10 years to repay it back. If you keep using that card, that repayment period extends. So you could have that card conceivably for 20 or 30 years, and it's always open to you and available to you.
So that sounds to me you really need to understand the conditions of, you know, the personal versus the credit card. Off stage, we had talked about those new minimum payment warnings that they have now. Can you explain that a little bit about how that helps people manage where their money's going?
Absolutely. One of the great reforms from the banking reform discussions were the minimum payment disclosures. So on your credit card statements, you will now see two items. One will indicate how long it will take you to pay off that credit card if you just make the minimum payment. And it will show you how much you will actually repay for the period that you opt to, if you opt to make just the minimum payment. The second item would be a 36-month repayment option. And it will show you what the payment required would be to pay that balance off without using the card again for a 36-month period. So it really identifies the two options to you very clearly and shows you that there could be a significant financial difference in the repayment of that credit card.
Yeah. So really when you're taking these loans and using your credit cards, you really should be considerate of what you're using the product for.
You want to look at the product. You want to understand what the variables are with the product. For credit cards, is there an annual fee associated with that product? Many credit cards that are out there may have a very appealing interest rate, but then on an annual basis, you're going to receive a $100, $75 annual fee that you have to pay. Whereas a traditional closed-end loan, you're not going to have those fees attached. It's part of the finance charge. Mm-hmm. So you do want to understand every component of the product you've selected so that you make the best decision for yourself.
Yeah.
And you want to make sure that as you select the products, you understand what you're signing. Your signature indicates approval and acceptance of the terms of the product you've selected. So a 5% credit card may be appealing, but if it has an annual fee of $100 and you don't use that card, it's just going to sit in your wallet. You're still paying the $100 annually, and you've signed and agreed to do that.
Mm-hmm. So it sounds like you really need to understand what you need to borrow the money for before you go after it. Whether you're borrowing for a short term and you want an end date, or you just want that flexibility of being able to access some credit when you need it.
Correct.
As emergencies arise. So you always hear debt is bad. Is there a good type of debt, or would you say there's no such thing as a good type of debt, or?
There are a lot of good debts. The first one would be a mortgage. If you're going to own a house, a condo, that's a great debt. You're owning an asset. You're paying for that asset over an extended period of time. Mm-hmm. Particularly in the Boston area, you're not going to buy a house for $400,000 in cash. You're going to need to finance that over a period of time. Same can be said for automobile loans, motorcycles. You're not going to pay cash for those items. You're going to want to extend the repayment terms to something a little more affordable, and those would be good debt. Student loans, tuition. You're going to go to college. You need to have a student loan. That's certainly good borrowing. The borrowing you want to be cautious of would be supermarket shopping, gasoline, items you should be paying cash with. You want to be careful. It does accumulate, and you want to make sure that you're not living on just the credit lines. You want to live on your income.
Your own income. So how much debt is too much debt, in your opinion? And
typically, most financial institutions will have a debt ratio that they will use to determine what you can afford. And a debt ratio is simply your income for a monthly basis versus your expenses for a monthly basis. And 45% is a traditional, very comfortable debt ratio. And keep in mind, that is based upon your pre-tax income. So we haven't deducted taxes out. We haven't deducted your health insurance out, any other types of deductions on your pay. It's based upon your gross income. So 45% is about the maximum that you'd want to have in a combination of secured and unsecured debt. Mm-hmm.
So it sounds like, when you're applying for those loans, you should really almost try to back out what your take home is after you've had those things, to make sure that, yes, I can spend 45% of what I'm bringing home, but am I really bringing home that much? What you get annually for what you get in your paycheck is it's a big difference.
It's a good idea to know what your income is going to. Mm-hmm. You want to know what your expenses are. You want to know that, okay, I have to pay my rent or my mortgage, I have to pay my car, I have to pay gas, I have to put food on the table. You want to know what your living expenses are, and then you want to know what you can afford to spend on other items before you make those purchases.
Yeah. So we've talked a bit about, the different types of debts there are, and some good and some bad, and how, some of them have positive sides to them, like getting a new car or buying a home. What can, let's start talking about what people can do who may be already in trouble. I guess the magic answer would be to find more money, but, do you have any tips on starting to go, like how you can get more money in your pocket?
Ideally, the first place you want to start is eliminating as much debt as you can. So if you have assets that you're not using, assets that maybe you could liquidate to help lower the amount of money you owe, that would be step number one. Step number two would be to try and increase your income if possible. If you can take that second job on, that would be a great way to allocate some additional resources towards what you owe. Finally, you do need to lower what you owe. And probably the best two places to start: number one, contact your creditors. Most creditors, most of the larger banks, most of the credit card companies will work with you if you have a history of working with them. You've made your payments on time, you've got a good history with them. Most of them want to work with you in these times of need. Some of the major credit card companies, their interest rates are already up at 16, 17, 18%. If you call them and explain to them that you're having some problems, they may be able to lower it to a more reasonable rate. The other thing you can do is ask them to lower payments for a short period of time, try and adjust what you have to put out in expenses to get through a short-term issue. The long-term issues are more difficult, but you would start on repayment with your highest interest credit card, trying to eliminate that first. And then in the industry, there's something referred to as the waterfall repayment method. Take what you can allocate to pay your bills, start with the highest interest card, pay the minimum on everything else. Once you pay off the highest interest card, move to the next highest interest card and allocate the exact same you were paying to the highest card plus the minimum payment for the other card, and just keep paying it off as best as you can. And finally, don't take on more debt when you're struggling. Put off purchases, delay, things you can't afford will have to be put off because you need to pay off what you've borrowed at that point.
Would you suggest that people really, if they're really struggling, they start just by finding out where their money's going, and where they're maybe being nickeled and dimed? Are you spending, what maybe seems like a small amount, like $20 on a gym membership a month, or $20 to get that extra expanded cable package? Would you recommend people start there and start figuring out what they can live without? Or
I think that's a great point, Kate. I think if you take your 1 month debit account statement, checking account statement, whatever you use with your income, and see where the money's going, it could be eye-opening. I'm sure that you can identify your favorite restaurant just by looking at your checking account statement, or an expense that you use on a regular basis. And really, if you're having financial problems, you may have to start thinking about, well, maybe I need to eat at home instead of going to the restaurant this week.
Yep. You touched briefly about reaching out to your creditors. I've heard about people sometimes in the past saying, if you call them and then maybe they'll lower your interest rate. How often, have you heard of that happening, or does it really seem to help you out? Is it more of a short-term fix or a long-term fix?
It really depends upon the creditor. I know our institution, we price our products at a very reasonable level. I know some of the credit cards, the store department cards particularly, are at the very high end of the level. Their interest rates can range 18, 21%. So you really want to be aggressive in identifying where your debt is and what the interest rates are. You want to make the phone calls to those high-end credit cards and try and get them to work with you. Most of them will work with their customers. The other thing you can do is, if you're having a legitimate problem, Consumer Credit Counseling Services, they're a nationwide reputable nonprofit counseling agency. They will assist you in making those phone calls. They may charge a small fee for you to enroll with them, but they will assist you in making those phone calls, identifying what a reasonable budget is for you, and they will share that budget with the creditors with the request that the creditors work with the customer that's approached them.
When you're trying to figure out how much you owe, it seems like one bill comes in, you pay it, it goes out the door. It's hard to kind of keep track of what exactly you're paying all the time. Is there